So reports have recently come out that the portion of the $700 billion TARP program, in other words the bank bailout, that has already been handed out was not treated properly. Elizabeth Warren, a professor of law at Harvard, and author of a couple excellent books on personal finance, All Your Worth and The Two-Income Trap, I definitely highly recommend these books. She's also a member of the TARP Oversight Committee, and she estimates the Treasury paid about $254 billion to get $176 billion in value. That's a loss of about $78 billion of taxpayer money. Now this loss didn't come because the assets that were purchased lost value after they were purchased. No, this loss came because Treasury intentionally overpaid for assets. Now to make this clearer, when people normally take losses on stocks, it happens because they buy a stock for a high price, say $20, and over time, the price of the stock happens to fall, say to $15. That's not what happened here. What happened here is that the person knew that the stock was worth $15, but paid $20 for it anyway. If an individual were to do this, we'd call it stupid. When the government does this, we call it a financial rescue plan. Now the immediate effects are rather obvious. Losses are transferred from the banks to the taxpayers. So the banks don't have to worry as much about the fact that they made loans that should never have been made in the first place. Instead, their executives can take home large bonuses and throw lavish parties for themselves, and the taxpayers get to watch the national debt, and the promise of future taxes that comes with it, grow ever larger. The longer-term effects, however, are far worse. Now, to understand why, we need to discuss the idea of a moral hazard. To demonstrate this idea, let me ask you a simple question. Suppose that we live in a time when airbags are not standard in cars. Then government sees that airbags can increase the likelihood of surviving an accident, and decides to require that all new cars have airbags. What do you expect to happen to the number of fatalities from auto accidents? Now, naturally, we'd expect them to decrease. After all, there's a new safety device in every single new car. But this reasoning ignores an important part of the story: the response of drivers to this new device. The fact is that when drivers have a greater assurance of surviving an accident, they drive more recklessly. As they drive more recklessly, they increase the number of serious accidents. Sure, the percentage of these accidents that result in fatalities is going to be lower than before. Airbags do actually work. However, the number of accidents has increased. In fact, it may have increased so substantially that the number of actual fatalities will have increased. So, a measure intended to prevent fatalities might actually cause them. Now, a similar problem arises when the government adopts a regular policy of bailing out failing companies. Now, to understand the structure, we can imagine a very simple gamble. Right? You flip a coin. If the coin lands heads up, I get $1. If it lands heads down, I lose $1. Now, it should be immediately obvious that I'd only take this bet if I just happen to like gambling. In the end, I don't expect to end up ahead, because the loss and the win are of equal sizes and equal probabilities, so they'll cancel each other out. Now let's say the government adopts a policy of intervening in this game. Whenever I lose, they will give me 40 cents. So from my perspective, if I win, I get $1. If I lose 60 cents. After all, I lost $1, but the government gave me 40 cents. So I'm only down 60. Now this is an obviously good deal. True, there's some risk of loss. I could still lose 60 cents, but that possible gain is much bigger than the possible loss, and it's just as likely. Now we can imagine that in this case, almost anyone who hears about this deal will want a piece of the action, even if they don't particularly like gambling. Now the result, then, is that lots of people make the bet, lots of money will get lost, and the government gets to do a lot of bailing out. Now the recent financial situation is very similar. In 1998, we bailed out long-term capital management. In 1989, the federal government bailed out savings and loans when they made risky loans that went bad. Continental Illinois, which was the 7th largest U.S. bank at the time, was bailed out back in 1984. Chrysler was bailed out in 1979. There has been a history of the government bailing out corporations as long as they are considered big enough to be important to the economy as a whole. So the incentives are clear. Become a huge corporation, regardless of the level of profitability, If you make any profits, you get to keep them. But if you take losses, make sure that they're very severe so that the government will bail you out. Now, there are two ways we can get around this moral hazard problem. The first is simple. Just don't bail anyone out. Yes, that means that there will be losses right now. Yes, it means companies might go bankrupt. Yes, it means people might lose their jobs and find out that the savings that they very unwisely put solely in their employer's stock will also be lost. However, allowing this process to happen creates good incentives for the future. Companies will take the potentiality of losses into consideration and will plan for them, preventing the need for bailouts or temporary loans. Employees will save independently from their employers, giving themselves a more secure retirement and providing funds for investment to the rest of the economy. In short, if we don't bail out companies, we should expect to see less need for future bailouts. In other words, the economy will be more stable. Now, the other option is the one that President Obama is trying to implement. Continue with the bailout, but add regulation to the mix to prevent the rise of irresponsible activities. Now, theoretically, this sounds like it might work. If you bail out banks that make subprime loans, you create an incentive to make subprime loans. So you have to offset this by putting other restrictions on the banks. Say you restrict executive pay, place restrictions on what types of business activities are legal, maybe banning subprime loans, and so on. This should help alleviate the problem. Unfortunately, it's not that simple for a few reasons, two of them worth emphasizing. First, you're relying on regulators to actually enforce these restrictions. If anything, recent events should prove the reality of what economists call regulatory capture. That is, regulators are captured by the people they regulate and write regulations not for the benefit of the people, but for the benefits of the regulated. Famously, the SEC was notified several times over the course of several years that Bernie Madoff was running a scam and that he needed to be investigated. Yet, as far as we can tell, they did nothing, implicitly giving approval to his organization and creating a false sense of security for his so-called investors. As far as the broader crisis goes, Hank Paulson, before he was Secretary of the Treasury, along with other investment bankers, convinced the SEC to remove certain capital requirement regulations back in 2004, allowing investment banks to become more highly leveraged than they had ever been before. Now, whether or not these regulations should exist, one thing is clear. The regulated, rather than the regulators, were calling the shots. Seeing how often that's the case, is it really reasonable to believe that government regulators will hold to regulations that actually restrict business activities? Now, second, even if regulators do keep regulations on the books, we have to be sure the regulations are of the right kind. This is extremely difficult. To get the right regulations, we have to foresee how the bailout will affect incentives, not only for the companies receiving it, but for other companies that might receive bailouts in the future. For example, banning subprime loans is unlikely to be enough. Why? Because the broader principle that big losses by big companies get absorbed by taxpayers is still true, and is true for everyone, whether they would give a subprime loan or not. The broader principle could have impacts on any industry, from automakers to fast food to retail to agriculture. So, the regulations also have to be something that would be expected to be broadly applied. In that light, capping executive pay seems like kind of a sensible regulation, though one could easily argue that it could be far from enough. After all, being told you can only make $400,000 a year is probably not a large disincentive to most people. But the principle, however, remains the same. Even if regulators can be trusted to hold to the regulations, and they can't, you have to make sure that the right regulations are in place. All it takes is a few cracks, and you end up with excessive risk-taking, followed by the need for more bailouts in another sector of the economy. In short, bailouts are a bad idea, not just because they're expensive, and they are, not just because we have a moral sense that people should pay for their own mistakes, and they should, but they're a bad idea because they create incentives for excessive risk-taking in the future. And that excessive risk-taking will result in more losses and more bailouts. If we want to stabilize the economy, we have to let people take the losses from the risks that they create. In the end, that will encourage them to take fewer risks, cause fewer losses, and create less instability.